Okay, as we have said earlier, we said earnings per share depicts the ratio of the earnings of an entity to the number of shares that the entity has outstanding for the reporting period. Also, we said what it tends to explain is of the earnings you made, what value can we attribute per unit of share of an enterprise? And that more or less speaks to average investor or every investor of what his or her own share has produced as earnings, which is a form of returns to the investor. And we said the importance of this ratio to average investor is that it forms the basis of making investors' decisions. And I've said earlier, those decisions entails the following. One is used to more or less measure performance of entity against the other, especially for comparables. Two, it is used in business valuation in ascertaining what is a fair value or what can be considered the intrinsic worth of a business compared to others. Now, this ratio is much important in allowing investors to reach those decisions. And the decisions investors consider or take within the capital market entails decision of either buying stocks or selling the stocks or holding on to the stock for the foreseeable future. And that is how important earnings per share is. Now, to break it down, when we talk about earnings per share, we look at a scenario where a company made 1 million naira earnings in a year, whereas the company has 100,000 ordinary shares in issue. That is the shares that form its capital structure. Now, the question then is, what is the earnings per share? Imagine you hold one share out of the 100,000. You ask yourself, how much return am I getting per share? And the return is simply 1 million naira, which is the earnings after tax of that enterprise divided by 100,000 shares. Because the 100,000 shares are the shares that has residual interest in that earnings. In that situation, we say 1 million divided by 100,000 will give us average amount of 10 naira per share. That's how simple it is. Very straightforward. And the standard says we should disclose this in our financial statements. And in disclosing this in a financial statement, is either we disclose it beneath our statement of profit or loss and other comprehensive income, or we disclose it within the notes to the financial statements. Now, majorly in Nigerian context, we disclose both at the bottom of the income statement and also in the notes to financial statement, where we provide more descriptive information for better understanding of the users of financial reports. Now, let's also look at it. Where does IAS 33 apply? The first thing we need to have understanding is that IAS 33 is a compulsory requirement for all listed companies. Listed companies are otherwise known as quoted companies. What does that mean? It means that these companies, as their securities traded on the stock exchange. Similar stock exchange in Nigeria are the Nigeria Stock Exchange and the FMDQ exchange. Okay, Therefore, every company that has their equity quoted in any organized exchange must disclose earnings per share in line with IAS 33. Also, from another perspective, let us assume all entities in this case are listed entities, but the entity can come in two forms. It can be a single entity, like let us talk about Finconomics PLC, is a single entity, okay? And it can be a group entity. Let's talk about Dangote Holdings PLC, for example, which might have subsidiaries. The question then is, what is the requirement to disclose earnings per share for a single entity or in a separate financial statement? You are equally required to disclose earnings per share. And your earnings per share will be relative to the amount of shares that is held by the shareholders of the entity, which means your earnings divided by number of shares. But for a consolidated financial statement, which is within the group, your earnings will be from the group perspective, which means it is after you've consolidated the profit or performance of other entities within the group in line with the requirement of IFRS 10. Such earnings will now be group earnings attributable to ordinary shareholders of the group. I remember the shares in the group will be solely the shares of the parent. Remember the principle of cancellation, okay, which follows through from the economic model for business combination. Okay, and as we move on, we have better picture of this. Okay. Now, these terms, I'm not going to define them now, but as we move on, when we are to make use of them at various points, I'm going to explain it. And later on, after we finish the course and you go back to look at those terms, you have a better appreciation, so that we don't just try to be defining or explaining things that you have not come across before, but upon illustrative discussion and we come across those terms, I will better explain, and that will provide us a better flow of understanding. Okay. Now, which earnings per share are we required to disclose? I believe if we go back to the requirement of IAS 1, presentation of financial statements. Apart from the discussion we had earlier with respect to presenting your items of income statement either by nature or by function, what is critical within the presentation is that in any year when you have a discontinued operation, and I believe a discontinued operation is disclosed in line with the requirement of IFRS 5. IFRS 5 deals with non-current asset held for sale and discontinued operations. And we borrow a leaf from there under IAS 1 that says that any year we have a discontinued operation, probably a business has 4 divisions, and one division was discontinued, stripped out, sold or disposed, or more or less closed. The standard says we should disclose the performance of that entity separately from those that are continuing. The essence of that is for comparison in the future, or because for us to be able to compare the performance of future years where the operations are reduced to 3 with the performance of this year when the operation was 4. They are not comparable. Therefore, to make it comparable, this year, when we discontinue an operation, we separate the performance of that operation and disclose it separately from the other 3 that are continuing in operation. So that by next year, when I show the performance of the 3, I can compare likes with likes. Okay? In that manner, it then means that my income statement will have 2 sections. The first section is what we call continued operation, which means I show my performance, revenue, cost, expenses, taxes, up to the profits from continued operation, which is after taxes. I'll now have the second layer, which talks about discontinued operation. And within the discontinued operation, the material line of items that contribute to the performance, either profit or loss, will have to be disclosed separately. But at the end of the day, for me to arrive at my profit for the year, even before other comprehensive income, which would be the aggregation of the profit or loss from continued operation plus profit or loss from discontinued operation. It is in that manner that IAS 33 draws that when we are disclosing earnings per share, also for comparison sake into the future, you must disclose earnings per share based on continued operation and earnings per share based on discontinued operation. And that more or less makes sense for us to have better appreciation and use of the information. Okay, as we move on, I'll reiterate again, even though we've explained it somehow. The requirement to present earnings per share, which we call EPS, remember I've said is only restricted to a public limited liability company that is listed in an exchange, which means companies that are not listed or that are limited are not mandated to disclose earnings per share. I repeat, if you are an entity that is not PLC and is not listed, you may not disclose earnings per share, or because you are not required. But remember that the standard does not restrict those that do not qualify but are interested in showing better picture of their performance from adopting it, which then implies that if a private entity or an entity that is not quoted decided to apply the requirement of IAS 33, such is permitted. But one thing that is unique there is that because you are not mandated does not necessarily mean that you not comply with the entire requirement, which means it's either you decide not to disclose it as a private company, or you decide to disclose it and you must disclose it in all respects as required by that standard, which means you are not going to use the latitude of saying, normally I'm not mandated, but I just want to do it, therefore I want to do it and modify it. No, you must do it in the same manner a PLC quoted entity will do it. Otherwise, you don't disclose it at all. And that is the position. Now, when we talk about earnings per share, it's of 2 types. Basic earnings per share and diluted earnings per share. Now, when we talk about basic earnings per share, the word means simple earnings per share on the surface, assuming shares in issue are the only shares outstanding without any potential of issuing any shares in the future as a result of transactions we have engaged today. I'll paraphrase it again. The word basic, anything basic means elementary, simple, primary. Okay? Basic earnings per share is simply saying that the earnings per share I'm computing only has information that shows that all shares available or ranking for dividend or currently in issue are the only shares that exist. And there is no contract or commitment at present that may expose the entity or force the entity to issue shares in the immediate future. Therefore, the denominator we have adopted is solely the denominator that represents existing shares as at the reporting date. And the second modification to it is that every shares that are taken into consideration will be ranked pari passu. What does that signify? Which means it will be ranked equally. But as you move on, you will find it that we need to carry out some adjustment or modification to rank some shares pari passu or equally. And I'll give you an example. Imagine the 100,000 shares has been existing from beginning of the year, January 1st, 2019 to end of the year, 31st December 2019. And the earnings for that year is 1 million. You will find out that the 100,000 shares, given that it ranked pari passu, will still produce 100,000 shares. But let's imagine that we started the year with 100,000 shares, January 1st, 2019. Sometimes in April, let's say 1st of April 2019, the company issues additional shares to the market. And let's say at the market price. 20 additional shares, 20,000 additional shares were issued. By the time we get to the end of the year, in absolute terms, the number of shares now in issue as at the reporting date is 100,000 plus 20,000, which gives us 120,000. Now, can we take 120,000 as the denominator representing shares that rank pari passu? The answer is no. Now, who can tell me the logic behind me concluding that the answer is no? Who can explain that logic? Who can explain that logic? Why 120,000 will not be considered to have ranked pari passu? Yeah?
The logic is that yes, sir. The logic is that the 20,000 shares does not qualify, was not outstanding as at the beginning of the reporting period.
Okay. What then will you advise for it to rank pari passu?
I'm going to put it by the number of months, which is 9 over 12 times 20,000.
Okay. Let me now, you've explained it numerically or from mathematical perspective. Now let me explain it from the logic here. Let's assume that a business started 1st of January 2019, and I called you guys to come and invest. Only 10 of you invested, and you invested 13,000 shares at the rate of, let me say, 100 naira per share. Okay? And 100 naira per share times, what's it called, 100,000 shares. I think that brings it to 10 million naira, if I'm right. Now, you guys contributed 10 million naira to start the business. Now, at the end of the year, the business generated profits of 1 million naira. But before the end of the year, the business needed additional capital sometimes. And 2 people, new people, came in 1st of April to contribute their own 100,000, which means at the end of the year, my capital is 12 million. Is that not? Is it 12 million or 1.2? 100,000 times what's it called? How much is the capital? Is 100 naira times 100,000 is how much? That, I think that's 1 million. No, that's 10 million.
1 million.
Is it 1 million? Let me use my calculator.
10 million.
10 million. Now, we now have two people that came in to subscribe on 1st of April 2019 to 13,000 shares, which is 20,000 shares at 100,000. That also gives me additional 2 million, which means at the end of the year, we close with a capital of 12 million. But this capital of 12 million cannot be seen to rank pari passu. Why? 10 million has been working to generate earnings from January to December. But the 2 million only contributed to earnings from April to December. The question then is, if I'm attributing profit, will it be fair to share the profit equally between those that contributed January and those that contributed April? And given that the performance has been generated from January to December, will it make sense for me to give them the same returns?
It won't make sense, sir. It has to be prorated.
Okay, now, it will make sense because what we should assume is that let us know what profit we made from January to March, and let us share that with the initial capital holders. So that when we share that, we'll now start to count the profit again from April to December. We can now share it what? Equally. That is the logic behind it. And in doing so, there is an underlying assumption that profit accrues evenly. There's this underlying assumption under EPS that regardless of the situation, profit accrues what? Evenly. Which means we assume that the performance in January, February, March, up to December are equally what? The same. And that is why the standard allows for extreme approximation, because it's not an exact science. It's just to give us a view of what the value or the performance of the entity is at a particular point in time. And that is that. Which then means that my definition of basic earnings per share will now be more or less specific to say the amount of my earnings, the amount of my what? Earnings as a ratio of the weighted average number of ordinary shares in issue. What is paramount is the weighted average, which says I have to weigh those shares that were in existence between January and December more than those that came in April to December. And the methodology adopted for weighting by the standard is what we call time proportion. It's what we call what? Time proportion, which means we are going to use time, basically months, days, or etc. to do that. But in reality, for examination, what we basically use is the number of months, not days. Because in the exam, how do you start to count days? But in real life, I can use days because I have my spreadsheet that can calculate days and do all sorts of things. But in the exam, we limit it to the use of months. Okay, and on that basis, we determine our weighted average. Now, the next order we need to cross is this. We have the numerator, which is the earnings. We have the denominator, which is the weighted average number of ordinary shares. The question then is, what is our earnings? Can I conclude that in every situation, the earnings remain the same? That is the first question. The next question then is, the weighted average, how do I determine it in different circumstances or situations? These are the two things we are going to battle with today with respect to having better appreciation and understanding of basic earnings per share. Until we finish basic, we will now introduce the principle that underlies the reason why the basic might be diluted in the future. And that will lead us to a discussion on diluted earnings per share. Now, let's simply look at it. Earnings is simply profit after tax, but it's subject to modification based on certain things. Now, if you find yourself in a single entity that within the capital structure, what it has only is ordinary shares as capital. In that case, profit after tax in your financial statement is your earnings. That is the definition of my earnings. Straightforward. But we start to have complexities. If within my share capital or my equity, I have two types of equity or two types of shares. I have ordinary shareholders and I have preference shareholders. Therefore, there's a twist. Why is there a twist? Remember that dividend payable to preference shareholders that are considered equity and dividend paid to ordinary shareholders are not yet deducted in arriving at profit after tax. Which means that that profit after tax is not solely attributable to the ordinary shareholders. Why? Because remember, preference shareholders must be given their own share before the remaining is given to ordinary shareholders. Which then means that in that situation, where I have preference share equity capital in a company, the earnings will be profit after tax minus preference dividend. It will be what? Profit after tax minus preference dividend. But there's another twist to it. I believe most of us have had discussion on IFRS 9, IAS 32, IFRS 7, everything borders on financial instruments. Now, IAS 32 makes us to realize that we have a form of hybrid instruments, such as preference shares, which at some point can be classified as equity. And at some other point, it can be classified as preference, as a liability. Now, if that is the case, if it is equity, how do we treat dividend of a preference share that is classified as equity? In our financial statement, we treat it as a distribution. That is why we treat it within the statement of changes in equity to deduct it from profit directly, retained earnings. We don't treat it as an expense, if you remember. But if a preference share capital is considered to be a liability in line with IAS 32, it then means that the preference dividend cannot be treated as distribution. Why? Because liability requires settlement, which makes it a liability and not equity. Equity requires discretionary payments, which make it much more of residue. In that situation, a preference share that has dividend paid in a year and that preference share capital is classified as a liability in line with IAS 32, we have such dividend accounted for as a finance cost or finance charge, not as a distribution. Because distribution is only to those classified as equity, while finance charge is those classified as what? Liability. Which then means that in that situation, the preference dividend would have been deducted along with finance costs before arriving at profit after tax. In that situation, you don't deduct preference dividend again because it has already been deducted within the finance cost. That means that we need to more or less appreciate and understand when preference share is said to be equity and when preference share is said to be liability. And we are going to look at some examples about that. The last reference is group. If we have prepared a group account and within our consolidated statement of profit or loss and other comprehensive income, we have our group profit after tax. The group profit after tax is not necessarily the earnings that we are going to adopt. But what is the earnings we are going to adopt? It's simply the group profit after tax less the amount of the group profit that is attributable to non-controlling interest. Remember, non-controlling interests are equity participants in the group other than that of the parent, which means you must take care of them first. Thereafter, you also take care of preference dividend, similarly to the single entity that we have discussed. It is what is left that will consider the earnings attributable to the shareholders of the group, and that is the numerator. Okay, and that is that. And let us start to look at it from practical perspective. And from there, we'll come back to explain some other things again. Now, let's look at the first scenario. Okay, I believe all of you have the material at hand because I'll be switching the board. Okay, let's look at this simple scenario. Scenario 1 says, let me enlarge it for some of us using phone. Scenario 1 says, Arsenal PLC currently has 1 million ordinary shares in issue as at the reporting date, 31st December 2019. The profit after tax for the year was 5 million naira. There has been no new issue of shares during the year. Required, calculate basic earnings per share for the year ended 31st December 2019, assuming the following. A, no preference share capital currently is in existence, which means the capital structure is solely of ordinary shares. Now, what can we say will be our preferred solution?
Sorry to interrupt. I don't really have this material, sir.
The material is shared, but what I'll do is that go to your chat. I'm going to share it in the chat session again. Is that okay?
Okay. Yes, sir.
You guys can go to the chat session. I've dropped it there. You can download it. Okay. It's already there for those that are interested in it. Okay, now let me share my screen to the board. Now, question 1. Earnings per share. Now, question 1 says the number of shares in issue between the beginning of the year and the end is 1 million shares. We are given our profits for the year to be how much? What is our profit for the year? Let me check my own.
5 million.
Okay. Now, and this is the simple question we have. Therefore, the question is, what is my basic EPS? I remember in exam, you must always define it. My basic EPS is my earnings attributable to ordinary shares as a ratio of my what? Weighted average ordinary shares. Now, my earnings in this case is as simple as my profit after tax. And this case is as simple as my ordinary shares, no adjustment. And I believe this is the earnings per share that we are used to in a simple ratio. Invariably, what do we have? 5 naira per share. Very simple. But we start to complicate things under this scenario. What does the B says? I think it's wipe off. Remember, I said profit after tax over ordinary shares, which is my 5 million as a ratio of 1 million shares. That is 5 naira per share. Now, I said this is A. Let us look at the B. B1 for that matter. The B1 says what? We now have preference share capital. Now we have 8% preference share capital of how much? Of 20 million naira. Now, given that means that my earnings is now profit after tax minus preference dividend. Now, what is my profit after tax? 5 million. What is my preference dividend? Remember, preference dividend is a fixed percentage of your capital, which is 8% in this case. 8% of 20 million. That is 5 million naira minus 8% of 20 million is how much?
1.6 million.
1.6
million. Invariably, what is my earnings attributable to ordinary shareholders? What is my earnings attributable to ordinary shareholders? Is 3.4 million. Is that correct?
Yes, sir.
Yes.
Right.
Yes, sir.
3.4 million. Now, therefore, my earnings per share, basic earnings per share, will now be, remember, every time you must define it, earnings attributable to ordinary share what? Holders as a ratio of my weighted average ordinary shares. And that gives me what? 3.4 million as a ratio of what? 1 million. And that gives me how much? 3 naira 40 kobo per what? Per share. Now, this is so because the equity and the preference share is classified as equity. Remember, it says preference share capital treated as equity with reference to IAS 32. Now, let's look at the next one. The next one says it is not treated as equity, but in IAS 32, it is treated as what? As we have 8% preference shares capital of 20 million naira. But with respect to IAS 32, it is classified as liability. If that is the case, unlike this, that IAS 32 classified it as equity. Now, what then do we do in this case? Because it is classified as a liability, it presupposes that the preferred dividend has been accounted for within finance charge, which means it has been deducted as part of finance cost before arriving at profit after tax. Which then means that, recall, preference dividend on preferred stock classified as a liability would have been deducted what? Deducted before arriving at profit after tax. Hence, preference dividend should no longer be deducted again, because doing that is double counting, because doing so will amount to double deduction. Remember, you are not writing this explanation for examiner. I'm just writing it for you when you are doing your revision to know why we reach that conclusion. Therefore, our basic EPS as defined will now be profit after tax over what? Ordinary shares. What's our profit after tax? 5 million. Because we assume that the preference dividend has been deducted by way of finance cost before arriving at that, which means this produces 5 naira per share. Now I can entertain questions if there's any. Any question at this juncture? Any question at this juncture?
Yes, sir.
Yes.
I have a question, sir.
Yeah.
Oh, sir, how can we get to know if the what's it called now? The preference dividend will be equity or liability? Does it mean that the examiner will tell us?
Okay. Let me when preference share, not preference dividend. Okay. Now,
Yes,
there are 2 or more ways in which you will know. Like me now, I'm a generous examiner. In the illustration I gave to you, I expressly state whether it is capital, whether it's equity or it is liability. That's the simplest situation you can find yourself, which means they've expressly stated it for you. But I can want to really understand whether you guys have the depth understanding. You know, it's not just by you cramming, but you really understand. And I can do that. Imagine I present you with a balance sheet. And within the balance sheet, I disclose within equity 2 capital structure, ordinary share capital and 8% preference share capital. I've more or less communicated to you what it is to be equity, nothing more. Or you saw preference share capital as part of non-current liabilities. Therefore, I've told you that is a liability, which means if you treat it otherwise as equity, you're on your own. And it might be additional information that they provide you with information. For example, I might give you information that we have 2 capital structure, preference share capital of 20 million naira at 8%, ordinary share capital of so at book value. And in one of the notes, I said this preference share is repayable after 5 years. What does that signify? It means this is a preference share that requires settlement. And I've told you the thin line between liability and equity. Liability will always require settlement, while equity requires discretionary payments. Which then means that for me to tell you that preference share is repayable or redeemable at a particular day, even if it's 100 years, it's more or less pointing to the direction that it is a liability. Are you getting it now? And that's why I emphasize that we are drawing this conclusion from the requirement of IAS 32. Remember, financial instruments. Okay, I think probably next week or one other week, we'll get to financial instruments, where you can also reiterate how we classify instrument into equity or into liability. Is that okay?
Okay, sir.
Which means directly or indirectly, the examiner will always provide sufficient information. Any other question? Any other question?
Hello.
Yeah?
Yeah. My question still goes to the classification of preference share. Is there any standard that guide us as per when we are preparing financial statements that it should be classified, preference share should be classified as equity or as liability?
I think that's what I just explained. IAS 32 will tell us when preference share is classified as equity or is classified as liability. Is that okay?
Thank you.
Yeah.
Very
That's
good.
why I said when we get to financial instrument as revision, we reiterate that. Okay, Mr. Lusoji. Mr. Lusoji, you are raising up hand. Can you speak out? I can't hear you. I can't hear you.
The material, can you resend it, sir? I can't see it on the chat.
Okay, I think I sent it privately. Okay, let me change it to all. Sorry.
Thank you, sir.
I sent it privately. Yeah. Okay, I think I've done that now. Please confirm if you've seen it. Confirm. Okay, now let's move on. Let's look at, let me return the screen. Okay, basic scenario 2. Can we mute? Can we mute?
Can we combine group chats lórí WhatsApp? Simple no miss orúkọ ìwé ẹ̀. So mo àmì tó bẹ̀rẹ̀ ṣe pé mo máa ṣe revision ẹ̀fà.
Okay. Scenario 2. Basic EPS with new issue of ordinary shares at full market price. Arsenal PLC currently has 1 million ordinary shares in issue as at the reporting date, 31st December 2018. The profit after tax for the year was 5 million naira. There was an issue of 200,000 ordinary shares on 4th of April 2019 at the full market price of 4 naira 25 kobo per share. Now, we are told to calculate basic EPS. Okay, look at the information. You can write it down, or you have the material already by your side, and let us compare notes. What it simply means is that as at the end of 2018, which was last year, we closed with ordinary shares of 1 million, which now in January 2019, we opened with that 1 million. That 1 million was there up to 31st of March, when on 1st of April, we issued an additional 200,000 ordinary shares. And we issued it to all shareholders, both existing, potential, public, at 4.25 kobo, which was said to be at full market price. The question then is, as at the end of 2019, when we made 5 million naira, what can we say is our basic EPS? What can we say is our basic what? EPS. Now, what we simply do is to extract that information and try to attempt solving the problem. The first thing that comes to me is this. As at 1st of January 2019, I have 1 million ordinary shares in issue. On 1st of April 2019, additional 200,000 ordinary shares were issued. And there's a clause there, issued at full market price. What it means is that when you issue anything at full market price, means there's no element of bonus. Nothing like free gift. You are paying the right price. Okay. Now, in 2019, between January and December, my profits after tax is how much? 5 million. Now, the question then is, what is my basic earnings per share? It is simply my earnings attributable to ordinary shares as a ratio of the weighted average of ordinary shares. Now, what is my earnings attributable? There's no adjustment to the numerator, which is simply 5 million. But where I have challenge is my denominator, which is X, unknown. The question then is, what is X? What is what? X. X is my weighted average number of shares. Now I'm going to show you two scenarios, two approaches of determining X. Now, approach A. I need my dates, or let me use the word period. I think that would be better. I need my periods. I need my shares. I need my time proportion. Remember, I told you weighted average is determined by time proportion. And I will have my weighted average shares, ordinary shares. Now, between 1st of January 2019 and 31st of March 2019, a day before new shares were issued, how many shares were in issue within that first 3 months? It is 1 million shares.
1 million.
And that is 3 months out of how many months? 12 months in that year. Is that okay? Yes. Now, but immediately after 1st of April 2019, additional 200 was issued, such that the number of shares between April and December 2019 is now what? 1.2. Do you get it now? As at yesterday, we closed with 1 million shares. Today we have issued additional 200. It means we are now moving at 1.2 till the end of the year, which means for a period of 9 months, this sum up to a year. For a period of 9 months, we carry shares of that. At the end of the day, what is the weight? The weight now is, I'll say X and Y. Therefore, Z is X times what? Y. That is 3 over 12 times 1 million. What is that?
250,000.
250,000.
250,000. And 9 over 12 times this is what? 900. All in all, what do we have? 150. Is that okay?
Yes, sir.
Now let me use approach B. Approach B says, I need the class of shares that is existing and new. What is the amount of shares? Number of shares. Existing share between the beginning and the end was 1 million. Additional shares was what? 200. That is what makes up 1.2. Now, let us ask the time proportion. This 1 million shares existed from January 2019 to December 2019. That is, it spent 12 months out of what? 12 months. Which means the weight is 1. And 1 times anything is that thing. But this new one, this operated for 12 months, this operated for what? 9 months. Therefore, 9 over what? 12. Now, what is my weighted average ordinary shares? 12 over 12 is 1 times 1 million is 1 million. 9 over 12 times 200,000 is what?
150,000.
I will get the same thing. Now, depending on the approach you are used to, the two will give you the same answer. But I will advise that always go with this first approach. Because when you get to certain level of complexity, this first approach will make it easier than the second what? Approach. Okay? And as you move on, you see why the first approach is easier than the second approach. Which that means that my X in this case is 150 shares. If that is the case, what then is my basic EPS? My basic EPS is now 5 million divided by 150. That is 4 naira 35 kobo approximately per share. Does that make sense at all?
Yes, sir.
Any question on that? Any question on this? Any question? Okay, if there's no question, we'll move on. Okay, let's now move to, let's go back to our initial screen. Now, let me give you a clue. Look at this question. Let me assume that I change Let me assume that I change let me assume that I change this date. I change it to 2019. I want to see whether some people are following me. If this date is 2019, sorry, I think this is not showing clearly. If this date is 2019, what will have been your answer? Let me divide you guys into two groups. Okay. I'll put you guys into two groups and discuss it in 5 minutes. And I'm going to divide it into, let me say, how many are you here? I'll divide you into 5 groups. And discuss. And I think you'll come back to, how many are here? Okay. Ajoda, Monday, Daria Labi, Infinix, Smartry, Ireti will be in group 1. Adeyola, Adetola, David Olusoji will be in group 2. Agada, Ayodele, Clement, Ifeanyi will be in group 3 with Sukomi. Group 4, Aziz Adewuyi. Okay, there are about 6 groups. I've opened the rooms now for you guys, and I'll close it as soon as possible. Have you joined your groups? Have you joined your groups? Okay, this group, Agada, you are still here. You've not joined your group. Okay, we are welcome back. Okay, who will speak for group 1? Who will speak for group 1?
Myself, sir.
Okay, can you speak? You have just 2 minutes.
Okay, the earnings per share is 5 naira 26 kobo. The
How do you arrive at
methodology,
it?
okay, the methodology being that if we have 1 million shares as at the end of 2019, and 200,000 shares was issued on April 1st, 2019, it means that as at April 1st, 2019, there was 800,000 shares, which will rank for dividend for the whole year. The 200,000 will be prorated for 9 months. If you add the total number of our next, it will give you 950,000. And if you divide the 5 million by 950,000, it will give you 5 naira 26 kobo.
Okay, group 2, who speaks for you? Group 2. Group 2, who speaks for you? Okay, group 3.
Group 3, I will speak for group 3, sir.
Okay.
Since the number of shares at the end of the year, 31st December 2019, is 1 million. So that means that, and we have been told that in the course of the year, on 1st April 2019, 200,000 shares were issued. That means that at the beginning of the year, the number of shares in issue were 800,000. So that means that for us to get the weighted average number of shares, we are going to rank the shares that from 1st January 2019 to 31st March 2019, we have 800,000. So we have to multiply that 800,000 with 3/12, which will give us 200,000. And for 1st April 2019 to 31st December 2019, whereby we have 9 months, so that will be 9/12 times the 1 million shares, and that will give us 750,000. So the addition of that 200,000 and 750,000 will give us 950,000 shares. So that will be our denominator. So our basic EPS will now be 5 million naira divided by 950,000 shares, and that will give us 5 naira 26 kobo per share. Thank you.
Okay. Thank you. Group 4. Group 4. Group 4.
Yes, sir.
Yeah.
I will speak for group 4. To my own understanding, I think the 1 million ordinary share being reported 31st December 2019 should not be considered because it was at the end of the reporting date. Then the 2 million ordinary shares that was issued 1st of April 2019, that should be considered, which should be prorated 9 divided by 12 times the 200 million, which will give us 150,000, and that should be our denominator. And our EPS should be 33.3. So.
Okay, group 5.
Okay, so I'll be speaking for group 5. So from our understanding of how the question was changed, saying that 1 million ordinary shares includes with December 2019, and that 200,000 ordinary shares were added or issued in April, it leads us to understand or assume that there was an opening of 800,000 between January and March. So following the first method you taught us, that would be January to March would have 800,000, which would be 3/12, giving a weighted average of 200,000. And then considering the addition of the 200,000 as at April would now sum up to the 1 million that they closed with as at December 31st. And that would be 9/12, which would give 750,000, totaling 950,000. So when we now have 5 million, that's the profit after tax divided by the weighted average of 950, we would be having an answer of 5 naira 26 kobo per share.
Okay, thank you. Group 6? Group 6. Group 2, again, do you still have representative?
Hello, sir.
Yes.
Okay. According to what we did, 1 million naira ran through to 31st December 2019, and there was an addition of 200,000 as at April. So the prorated as at April to the end of 31st December, which gave us 900,000 plus the additional plus the 1 million naira that ran through 31st December. So dividing 5 million by 1.9 million gave us 2.63 basic EPS.
2 point what?
63.
No, explain again. I didn't get it.
I said we prorated from April to 31st December 2019
Okay.
of 200,000 additional.
Yes.
And it gave us 900,000 for that 9 months.
No, how do you arrive at 900,000? No, how do you arrive at 900,000?
From April to 31st, yeah. That's 9 divided by 12.
Times what?
Times 200.
That would give you 150.
We did 9 divided by 12 times 1.2.
Times 1.2. That gives you what?
Yes. 900.
Okay. What is now your basic EPS?
The basic EPS is meant to be 1.150, not 1.9. I think that was what we got it from.
No, I think you still missed it up. You still missed it up. Okay, no problem. Let us wrap it up. I think out of the 6 groups, only 3 groups got it exactly right. Now, we need to start to shift away from trying to just grab something on the surface or try to cram than try to have depth understanding. The twist to the question is this. They've given you number of shares absolutely in issue as at the end of the year to be 1 million naira. There's no bone of contention there. But for me to have 1 million naira, 1 million shares as at the end of the year, and I was told that in April of that year, there was an issue of 200,000 additional shares. It then means that for there to have been an issue of 200,000 shares, and as at the end of the year, I have 1 million in total. It means I opened the year with less than 1 million. And by working it out, you discover that you opened the year with 800,000. 1st of January 2019, you opened with 800, which means as at 31st December 2018, you closed with 800. That's why you opened with 800 on 1st of January 2019. And by April, you have added 200. That 200 to 1 million, to 800 is what brought it to 1 million. Which means that to determine my basic EPS, my weighted average number of shares will simply be 800,000 full year and 200,000 9 months. Or I aggregate 800,000 for 3 months and 1.2 million for 9 months. I'll still come to a conclusion of 950. And by the time I divide 5 million by 950, you get what your colleague said. I think 5 na 26 kobo. Is that correct?
Yes, sir.
Okay. Now, can you see the twist? Which means if you don't have depth understanding, this same question, examiner will just leave this question and change 2018 to 2019. You find out that people that have crammed answers will just go there and dump it and say, this question, we've seen it before. Whereas you don't know that there's a twist, which means this is what depicts the difference between those that really understood and those that are only following the solution just to have an idea of how to drop the solution. No, you need to have better appreciation and understanding of this. And I'm very happy that significant number of people in the class are able to grab it. Any question? Any question? Okay, now let's move to the next scenario. Now we want to discuss scenario that involve bonus shares. Now, what is a bonus share? Who can tell me a bonus share? What's a bonus share? What is a bonus share?
Capitalization of reserve.
Yeah? Capitalization of reserve. Who else can?
Capitalization of reserve.
Yeah, who else can give us other perspective?
Capitalization of reserve.
Yeah, I got it right. But who else can give us another perspective? I want to have different perspective to it. Who else can talk about bonus issue? Or what gives rise to bonus issue?
All right. Bonus issue, from my own understanding, simply means the dilution of the existing number of shares.
I don't think that is correct. Okay, let me take you to
my own understanding.
Okay, yeah, Sadiq.
Bonus share are share distributed by a company to its existing shareholder as a full paid share. Like it's just give them free. It's free to the existing shareholder in order to capitalize the part of the company retained earning.
Okay, thank you very much. Okay. The history is this. Return other than capital appreciation that goes directly from the entity to the shareholders can come in form of cash dividend or stock dividend. Cash dividend means you pay them in cash through your dividend warrant. While stock dividend means that instead of you paying them cash, it's presumed you pay them cash and they are using that cash immediately to buy back or to buy shares, which means it's like in-kind dividend, which means instead of me giving you that cash, I'll use it to help you to buy shares, that same shares of the company, and increase your shares. That's why we call it a script issue or a capitalization issue. Okay, which means it's just a mere reclassification of your distributable earnings through your retained earnings to your capital as a permanent equity. Okay, now, when bonus is issued in a year, it changes the denominator by the amount of bonus issued. What does that mean? If last year you closed with 1 million shares, and this year you ought to close with 1 million shares, but the company now issue bonus of, let me say, 100,000 shares. It then means that you'll be closing with absolute of 1.1 million shares this year. But the question mark there is that, does bonus shares contribute additional resources to the entity? The answer is what? No. Because it is still internal resources that is available to the entity that is merely recapitalized. There is no new injection of capital which forms an additional resource to the entity. Which then means that even though the denominator increases in value, it should not distort the flow of comparing performance between prior period and current period. Therefore, what do we do? As we recognize increase in denominator by the bonus shares, we should make a corresponding adjustment to the prior year to reflect that same effect of bonus, or because the bonus is already inherent even as at last year, because what you are recapitalizing is as a result of your retained earnings, that is aggregate earnings over time. Which then means that in that situation, whenever there's a bonus issue which affects the current year EPS, you must adjust for prior year. That's why we have in financial statement that we call adjusted EPS. Adjusted EPS is adjusting the basic EPS of a prior year, all because of the issue of bonus in the current year. Secondly, if bonus is issued at the beginning of the year, it's okay. But what if the bonus is issued during the year? Are we going to prorate based on time proportion? Who can advise? Are we to prorate similarly to what we have done for normal issue of shares? Are we to prorate? Tell me yes or no and why. I'm expecting contribution. Any contribution? Any contribution? Hello?
Sir, please, can you recap the question again?
I'm saying that if bonus is issued in April and the year runs from January to December, are we equally going to prorate for weighted average purposes? Are we going to prorate the bonus also for 9 months or for 6 months or for 3 months when it was issued?
Hello, sir. Hello, sir.
Hello, I can hear you.
I think we are not prorating because it should be assumed the bonus was also issued at the beginning or already existed at the beginning of the year.
Why so? Why such an assumption?
I just feel that's the way it should be. Because since it's a bonus issue, it should be assumed it's not a new issue of share. It already existed at the beginning of the year. Just as
Where was it existing? Where was it existing?
Let's just say, for instance, probably the accounting year was 1st of January to December, runs from 1st of January to December. So we assume it runs from 1st of January to 1st December of that same year.
Okay, now you got it right, but let me try to break it down. Remember, bonus is recapitalization of undistributed profit. And this undistributed profit has been aggregated over time. Therefore, which means the bonus shares already exist prior before now. Forget when it was issued. When it was issued was what when they only decided, but it is already existing. It's embedded in the retained earnings prior to now. Therefore, regardless of whether it's issued at the end of the year, 2 months to the end of the year, at the beginning of the year, it is deemed to have been in existence from the beginning of that financial year. Which then means that issue of proration does not apply. Issue of what? Proration does not apply. Let us look at this scenario 3 as an example. Arsenal PLC currently has 1 million ordinary shares in issue as at the reporting date December 2018, which means as at 1st of January 2019, we opened with that 1 million shares. The profit after tax for the year was 5 million. There was a bonus issue of 1 for 10 ordinary shares. What it means is that for every existing 10 shares, you get 1 million, like 1 share. And this was as at 1st of April 2019. Can we move? Hello? Okay. Now, the basic EPS for 2018, given no new issue of shares, was 4.58. That was last year basic EPS. has completed. And last year, there was no bonus issue. But this year, there was bonus issue. The question then is, we have to calculate our basic EPS for this year and adjusted EPS for last year. Okay. How do we do that? Question 3. Now, as of 1st of January 2019, we had 1 million shares in issue. On 1st of April 2019, bonus shares were issued at 1 for 10. What it then means is that the bonus shares will be 1 new share for every 10 existing times how many shares were existing as at the day it was issued? 1 million, which gives me additional 100,000 shares. And note, regardless, when the bonus shares were issued during the year, it is presumed that such were issued as at the beginning of the year, because it were issued from retained earnings already existing prior to now. That is the reason why. Therefore, we jettison any other thing and presume that that is the position. Invariably, my basic EPS, which is earnings attributable to ordinary shares as a ratio of my weighted average ordinary shares in issue. And what is my earnings? I think it's still 5 million. And what is my weighted? Now, because I'm not going to weigh my bonus, because it is presumed to be issued at the beginning of the year, which means 12 over 12 is still 1. Therefore, I will now add it to say my number of shares now is 1 million plus what? 100,000 shares. Invariably, that is 5 million over 1.1 million shares. How much is that per share? How much? 4 naira. 55 kobo per share. This is my basic EPS for 2019. Now, comparatively, I need to adjust my basic EPS for 2018. Why? Because if I go and compare this, it will look as if last year is better than this year. But remember that this year, we only increase the bottom line by mere recapitalization without additional capital, which then means that I have to go to 2018 and also do it as if in 2018, there was a bonus what? Issue, which then means that I'll come here and say adjusted EPS for 2018. It will simply be the basic EPS in 2018 multiplied by the adjustment factor. Multiplied by the what? Adjustment factor. The question then is, what is the adjustment factor? The adjustment factor is simply the existing shares as a ratio of the total what? Shares after what? Bonus. What does that mean? The existing shares is 10, after bonus is 11. Or simply put, the existing share was 1 million, after bonus was what? 1.1 million. It's still going to be the same fraction, which means we are doing either in units or in O. Therefore, my adjusted EPS for 2018 will simply be for what was last year, 4 naira 58 kobo, multiplied by what? 10 over what? 11. What is it? It's
4 naira 16 kobo.
4 naira 16 kobo. Per what? Per share. This is our adjusted, because I put all of them on the same pedestrian, on the same basis, so that given that the bonus was issued last year, what would have been the earnings per share? It will have reduced to 4 naira 16 kobo. Therefore, I can now say I'm comparing apple with apple. Do you understand? But if it is additional resources, it's already apple to apple. That is what we have been doing before now. Because additional resources, we must be able to evaluate whether it's contributing to higher performance or no. But when it comes to bonus shares, it's not additional resources. It's the same existing. It's like reinvesting your profit, which is already existing. Do you get what I'm saying now? And that is the position. Any question about it? Any question about that?
Sorry, can you please explain over again? I'm trying to.
What we are saying is this. That's why I started with the simple principle of, do you really understand what bonus shares are? If you don't understand that, it will be problematic. I would say bonus shares is like a company has made profit over the years. Now, instead of paying most of those profit out, they retain it in order to expand the business. And to retain it also, they made the choice to say, okay, let us make it a permanent capital. So that is a permanent reinjection of capital into the business. And by doing so, they issue new shares to existing shareholders for no consideration. Now, this will increase the number of shares that are in issue, but it's not contributing additional resources from the outside. It's using internal resources. Therefore, we are now saying that for the computation of basic EPS, even though we increase the number of shares, we are not going to prorate it based on the period in which it was issued, because it's something that was existing even from the beginning. Now, after doing that, we arrive at 4 naira 55 kobo. But last year, it was 4 naira 58 kobo. If I have no information to the contrary, I would have said my last year is better than this year. But I'm wrong. Why am I wrong? I'm wrong because I have only increased the number of shares this year, even when there was no new injection of capital. Which then means that I'm not putting them on the same scale. Therefore, that same amount I capitalized this year, I would have even done that last year, because that retained earnings also has been existing since what? Last year. Therefore, let me go back last year and assume that if I've done it last year, what will have been the effect on my disclosure of basic EPS? The effect will have been 4 naira 16 kobo and not 4 naira 58 kobo. Therefore, I will now come here to say, give me effect of bonus. This year, the basic EPS is 4 naira 55 kobo. Last year, it is 4 naira 16 kobo and not 4 naira 58 kobo, because 4 naira 58 kobo never take into cognizance bonus. Very simple. Any question again?
Thank you very much, sir.
Okay. Finally, we'll look at right issue. How many of us have come across right issue before now? Right issue. What is a right issue? Who can explain? What is a right issue? Who can explain?
It's an offer to existing shareholders to increase their shareholding, basically, as to purchase more shares at a given price.
Is that all?
Sir.
Yes.
Hello, sir.
Yes,
in
sir.
addition to what he just said, to what he said, the new shares will be given at a price below the current market value.
Why is that so?
Basically, because they are existing shareholders. Just like you are giving them the right.
Why will you decide to issue shares to existing shareholders at below the market price? Why? You know, every action you take in this life, there must be a rationale behind it, whether it's logical or not. There must be something driving it. Why?
Let me express.
Answer that. You know, one thing you need to start to learn. Hold on, madam. One thing you need to start to learn is that as a professional accountant or finance professional, you need to understand the rationale for everything, because that is what will put you in a position of always having intuitive mind and making the right decision. Not that this is how they always do it. What from the reason why they are doing it like that? Why can't it be in another manner? Do you get what I'm saying now? We need to start to have what we call critical thinking as professionals in everything we find ourselves. Okay, Madam Ireti.
So in my opinion, I would say one of the major reasons why you would issue right issue is to increase the company's capitalization.
Okay, but why are you issuing it at below is what?
I think just to compensate them.
Compensate them for what? Are you not paying them dividend?
I think the reason is because the company want to raise the fund.
And why can't you raise the fund from additional shares that we even get more price at full market price?
I think it's just to compensate the existing customer, existing shareholder, instead of going out to the market to go and.
Okay, now the question is this. The question is this. Put yourself in a position that you're on the board of a company and you're having deliberation. Some are saying, no, let us issue additional shares at 5 naira. Some are saying, no, let us issue it at 4 naira 50 kobo, our existing shares. And you are part of people that wanted you to issue it at 4 naira 50 kobo for existing shares, whereas I wanted it to be issued at 5 naira to external. Convince me to, because you know in a board is a vote. Convince me. What is the rationale for you saying 4 naira 50 kobo, which is below 5 naira?
All right.
What's the
Hello, sir.
I can hear you, sir.
Okay, I think the reason, there could be many reasons for a right issue, but I think the reason that could be behind issue of making a right issue is when the company's share is somehow relatively high, such that it will not be easily patronized by outsider, but you can make right issue to your existing shareholders at a reduced price, such that they will subscribe to it, since it is their own, it is their companies. It is their company.
Okay. Now,
because this right issue affect the capital market and equity capital.
I didn't get it. Start again, please.
You mean me, sir?
No, let him repeat himself. You are saying something capital market or something. Somebody is saying something, Yusuf. Can you repeat yourself?
Say the right issue
Hello, sir.
affects the equity capital and market capitalization.
Whether additional shares or right issue, they both have the same effect on your capitalization. Okay,
Yes.
Daria, you are saying something.
Hello.
Okay.
I will consider in this scenario that firstly that what will prompt a company to issue right issue. Hello.
Repeat yourself, please. I didn't get you.
What will prompt a company to issue right issue? I think one, I would say to avoid the expenses that will be incurred in putting their shares out there. And secondly, if they are in need of urgent capital, they can go for right issue.
Okay, thank you.
Hello, sir. Hello, sir.
Hold on, Daria, please. Now, for Rosemary, the first stop will not be cogent. Okay, why? Because first, if I issue at 5 naira, I get more. If I issue at 4.50, I get less. It's not possible that if I issue, the whole cost of issuing will be 50 kobo, so that it erodes that value. And remember, there are some fixed costs to both whether right or existing, which means I can't argue in favor of issue of cost of issue. But I can argue in the second one to say the urgency will make it easier to close up right issue than to issue additional shares. I think that can also go hand in hand. And the first person that spoke about it, or second person, which speaks to the fact that the success of right issue is usually higher than the success of new issue. You know that when you say you want to issue shares, before it can be approved that it is successful, it must pass certain tests, certain minimum of number must be subscribed to. But sometimes companies might find it difficult that if they open it to the public, it might not be easily subscribed to. Therefore, they believe that the existing shareholders understand the business, they know the prospect, they are less easy to convince. Do you get what I'm saying now? Or I would say they are more easily convinced than new people, which means they already know the trajectory. By the time we raise it, we are not speaking too much grammar, we are not doing too much of analysis, we are not doing too much of promotion for us to get it right. And also, it's an incentive to say, we don't want to dilute your future earnings from bringing external people. Therefore, let us allow you that have been laboring for 10, 15 years to this company, continue to enjoy the prospect. These are the rationales for doing right what issue. Okay, Dari.
Yes, sir, you have said it. I wanted to mention dilution of shares.
Okay. When I say dilution now, it's not necessarily going to dilute EPS, but it's going to dilute individual interest.
Holdings.
Okay. Exactly, holdings. Okay, and that is that. Now, let us now look at it. It is also possible that you can issue right at the same price as market price. I think it has happened once or twice in Nigeria context, but it could happen. Okay, but most times, right issue is issued at a below market price. Now, if right is issued at a below market price, what is the implication? Who can tell me? What is the implication if right issue is issued at below market price? What is the implication?
Hello, sir.
Yes, sir.
So what if we say right issue is issued below market price? Like you mentioned when we were doing something on a bonus, and that is scenario 2 then. You said bonus doesn't have any financial implications since the fund, it is assumed that it's already in the reserve. What if we say because they now issue it below market price, they can also still fall back to the reserve and draw to make it up? Hello, sir.
Yeah, I can hear you.
Am I making any sense if I assume that way that the balance?
Yeah.
to make it up can also be drawn. You can liken it to be a bonus.
Okay. Brother.
Something like that, sir.
Brother, you've made more than a simple sense. You have made a logical sense, and I will explain. This is the full market price. Let me say it's 5 naira. And this is the right price, right issue price. Let me say it's 4 naira, 50 kobo. Okay. Now the difference between 5 naira and 4 naira, 50 kobo. Is this amount 50 kobo. Now, what is deemed to have occurred here is this. From year to year is 4 naira 50 kobo, which is now equal in length with this and breadth. Now, what is said to happen is that you pay your right price, which is 4 naira 50 kobo, and you are given bonus of 50 kobo. That's what we're saying, and that's what you have explained. That's why I said you have made more than a sense. You have made a logical sense. Do you get what I'm saying now? And that is what has happened, which means in every right issue, in every right what? Issue that is issued at a price below the market price, there's an element of bonus inherent or embedded in the right issue. And therefore, that will make us to ascertain what is known as theoretical X right price. Theoretical what? X right price. And what is theoretical X right price? Theoretical X right price is saying obtain the value of existing shares and equally obtain the value of the rights. That gives you the new value of the business and compare it with the number of existing shares plus the number of rights. And this theoretical express price is like a weighted average price after infusing existing with the rights. Now, let me tell you a secret. The secret is this. There's no way the right price will be higher than the market price because it's like a disincentive. The market price is 5 naira. I am not telling you existing shareholder to come and pay 5 naira 10 kobo. It's like, what sense does it make? Therefore, the maximum price you can sell is the market price, but you can sell below it. Which then means that if you sell, if right price is equal to market price, hence the theoretical X right price will equally be equal to the market price and also equal to the what? To the right price. But if the right price is issued below the market price, hence the market price will always be higher than the theoretical X-right price, and the theoretical X-right price will always be higher than the what? The right price. I'm trying to establish a relationship, and I will explain with an example. Now, let's go back to our question. Can somebody read this question, scenario 4? Can somebody read scenario 4? Can somebody read scenario 4?
Arsenal PSC currently has 1 million ordinary share in issue. As at the reporting date, 31st December 2018, the profit after tax for the year was 5 million naira. There was an issue of 200,000 ordinary share on 1st April 2019, 4 naira 10 kobo per share to existing shareholders. The market price of its ordinary share before the new issue was 4 naira 50 kobo per share. The basic earning per share disclosed for 2018 was 4 naira 36 kobo per share. Require calculate basic earning per share for 31st December 2019 and adjust EPS for 2018.
Now, what does this question say? That we opened the new year 2019 with 1 million ordinary shares. In April, we issued additional shares, which means we are injecting new resources. But these additional shares were issued and restricted to existing shareholders, which make it a right issue. And again, in the right issue, we equally embedded a bonus equal to about 40 kobo per share to existing shareholder, because a share that is going for 450 kobo, we issue it for 410 kobo, which means they pay full price of 410 kobo and bonus of 40 kobo. Okay. Now the question then is, what is the theoretical extra price? That is the first bone of contention. What is the theoretical extra price? I share my screen again. Scenario 4.
Please help me with this material so I can follow.
Help you with what?
The material. It has not dropped for me.
No, we have sent the material more than 3 times. It's there. It's there. Are you just joining?
No, I'm not just joining.
Oh, it's there. It's
Maybe
there.
I don't know how to access it. That is the
Go to the
problem.
chat.
I send my number.
Go to the chat. Go to the chat. In the chat group,
I'm there now.
Can't you see any per share folder? I even dropped past question folder just now. Can't you see it there?
No, sir.
Okay, for the last time, I'll put it there again. Please let us learn how to use Zoom.
I think that is a problem.
I've resent it again. I've resent it again. Okay. Okay. Now, question 4. We have market price of 4 naira 50 kobo. We have right price of 4 naira 10 kobo. Okay. And as at 1st of January 2019, we had 1 million shares in issue. As at 1st of April 2019, we had 200,000 right shares. The question then is, what is our theoretical extra price? I can use a simple table. Class of shares, okay, number of shares, unit price, and value of shares. We have 2 classes of shares: existing shares and right shares, right issues. Now, what was the right? We had 1 million existing shares and we issue right of what? 200. If you are to convert it to the language of right issue, how many rights for existing shares will you call this? What ratio is it?
1 for 5. 1 for 5.
1 for 5.
Which means for every, how do you determine 1 for 5 is 1 million divided by 200 will give you 5, Abi? Which means for every 5 existing, you are issuing 1. If you are a shareholder that has 5, the maximum right you can buy is 1 share. That's what it means. The reason why I'm emphasizing this is that a question might come and we just tell you 1 million shares at the beginning, right of 1 for 5 was issued. So that you say, but that's not how we are taught. That's why I said it is understanding, not format of question or pattern of question. Things have changed in the world of today. Nothing like pattern. It's your understanding that matters. Now, that is why, as at the end of the year, in absolute terms, we have 1.2 million shares. Now, the existing share in the market is going for how much? 4 naira 50 kobo. Now, if you value this share based on market capitalization, it's the worth of the company before now was 4.5 million. Now we have issued additional shares at 4 naira 10 kobo. The worth will simply increase minimally by 4 naira 10 kobo times 200. And that gives us how much?
820.
That gives us how much?
820,000.
Okay, 4.1 times 200. I hope everybody's contributing.
Yes, sir.
Yes, sir.
That's 820. Now, 820,000 plus 4.5, what do you have?
5,320,000.
5,320,000.
5,320,000. Now, what is my theoretical extra price? The formula I wrote earlier is the value of existing plus the value of right will give me how much? 5,320,000 over number of existing shares plus number of what? Right, which is what? 1.2 million. Therefore, what is my theoretical extra price? It is 4 naira 33 what? Kobo per what?
43, sir.
Okay, 43. Thank you.
Yes, sir.
4 naira 43 kobo. Now, can you see now that when you look at it, market price when you look at it, you see that market price of 4 naira 50 kobo is higher than theoretical extra price, which is what? 4 naira 43 kobo, and that is higher than the what? The right price of how much? 4 naira 10 kobo. Now, theoretical extra price always represents the average price, which is always in between the market price and the right price. Okay, what do I need? I need 2 adjustment factors from this theoretical extra price. The first factor, 2-factor analysis. The first factor is what I'll call bonus factor or bonus adjustment. And that is, this bonus factor is cum right price over theoretical extra price. Cum right price is simply known as the full market price. And in this case, it is 4 naira 50 kobo as a ratio of 4 naira 33 kobo. Now you might convert it to number in decimal, and you might decide to leave it like that. I would advise that to leave it like this so that when you are applying it, you get exact answer rather than approximation. But let's convert it. 4.5 divided by 4.33. I think I can say it's 1.0393 approximately.
Sir,
That
it's
is
1.01. It's 4.43, sir.
Okay, it's 4.40. Why am I putting 4.33? Okay, thank you. .43, that's 4.5 divided by 4.43.
3.
It gives me 1.018. Now, the second factor is comparative adjustment factor or factor. And it is a reciprocal of bonus factor, which is theoretical SY price from right price, which is 4 naira 43 kobo, the ratio of 4 naira 50 kobo. How much is that? That is 0.9844. Now, one thing I'll tell you is that given that this equation is right, or given that this equation exists, every time you have your bonus factor greater than 1, the minimum is that it's equal to 1. It's only equal to 1 when the right price and the market price are the same. But whenever it's not the same, the bonus factor will always be greater than 1 because of the bonus element embedded in it. While the comparative adjustment factor will always be less than 1, or at least equal to 1. It's only equal to 1 when the right price and the market price are the same. But if not, it will always be less than 1 because of the adjustment factor to the comparative period. Now, to solve the question, says, what is our basic EPS for 2019? To do that, I'll say my basic EPS in 2019
Talk about what?
Is earnings attributable. Remember, I told you must always define to ordinary shares as a ratio of the weighted average ordinary shares. What is our earnings? Our earnings is it 5 million?
It's 5 million.
5 million. Over weighted average number of shares. Now, let me calculate weighted. Period. Shares. Time proportion. Bonus factor. And weighted average shares. Now, what is the period? Between 1st of January 2019 and 31st of March 2019, it was only 1 million shares existing. But between 1st of April 2019 and 31st December 2019, additional 200 shares, which make up 1.2. But this existed for 12 months. This existed for what? 9 months. Now, there is presumed that there is bonus element embedded from the beginning of the year. Remember the principle of bonus, which means before this bonus was issued, it was existing as at this period. Therefore, we adjust for the bonus factor, which we call 1.0158, or simply put, 1.0158. Therefore, there will be effect of this bonus, which means if this is A, if this is B, this is C. After that, the effect is 1. Therefore, this will not be, D will be A times B times C. The only thing that is new here is the bonus factor. Therefore, can we multiply? This will be 150 because effect of 1 is 1. Now, what is the other effect? 1.0158 multiplied by 3 divided by 12 multiplied by 1 million.
253,950.
No, hello? No, this 1.2, I mean, sorry. This 1.2. Therefore, remember, we are using this methodology. We are not using the former one. That's 1.2 times 9 over 12. That's 900. It's 900. Okay, this 900, and this is what? 1.253,950 times 1 million. Sorry?
253,950.
Okay, I'm just trying to confirm on my own. I hope everybody is confirming. How come my own is showing 264? 1.0158 times 3 divided by 12 times 1 million. That is 253,950. 950. When you sum it together with 900, what do you have?
1,153,950.
Which means our weighted average is 1,153,950 shares. Invariably, what is our earnings per share? $4.33 per share. That is that. Now, in 2018, we will now come back to adjust because there's a bonus element there. Remember, I told you that bonus. Anytime we use bonus this year, we must go back to adjust for the effect last year to put them on the same pedestal. Therefore, B says adjusted EPS for 2018. The answer will be basic EPS for 2018 multiplied by the what? Comparative adjustment factor. And that is, what was our question? What was our basic EPS last year? Let's go back to the question.
4.36.
4.36. Can you all see it?
Yes, sir.
Okay, 4.36. Let us go back to our solution page. I'll come here, 4.36 multiplied by my factor. What is my factor? Comparative adjustment factor is 0.9844, which is the reciprocal of 1.0158, which means 0.9854. Is it 54?
44, sir.
4.9844. Okay. Okay, what that gives me is going to give me a reduced amount of
4.292.
That's 4.29 per what? Per share.
Sure.
Therefore, this is when I can now compare my performance in 2018 with my performance in 2019. Does that make sense at all?
Sure.
Yeah. That is that for basic what? EPS. Now, what I'll now do is that I've sent you guys past question for May 2017 when it was tested in question. You guys can download it. It's on your chat. The question is which year? Question 4. Question 4 of May Diet 2017. I will divide you guys into groups, and you have to attempt solving the question now. Have you all downloaded the question before I divide it into groups?
Come on.
Have you all downloaded the question before I divide you into groups?
Come on.
Have you downloaded the question?
No, sir.
It's on your chart. Please, I'll give you 1 minute to do that. Have you all done that now?
Question what?
Question 4.
All I do.
I've resent it again. Please let us go on YouTube or the Zoom website to learn how to use Zoom. Have you all seen it again now? Okay, I'll divide you into groups now. I'll only put you in 2 groups. Agada, Ayodele, Aziz, Nuruddin, Odimegu, Olusoji, Sukomi, Techno, L8 Plus, Yusuf Abdullahi are group 1. Damilola Williams, Daria Labi, David Ifeanyi, Ireti, Michael, Rosemary, and Sadiq are in group 2. Okay, I've opened the group now. You guys can go in. Sukomi, you are not in your group. Olusoji and Osabia, please join your group now.
Explain the following.
Sir, please fix me in a group, please. Hello? Hello?
Hello.
Hi.
Yeah, I don't know. I just log in back. I don't know the exact question they even give to us. So.
I too don't know. I've been trying to log in for a while. I've been having network issues.
I don't even know what the question is. I don't know where they stop. And Mr. Victor is just muted his own stuff now.
Eh?
I see Mr. Victor now muted his own. He can't hear us.
When did you leave the group? Like, when did you leave the chat?
For like 10 minutes now, or approximately 10 minutes.
Wow. You have left the
Just
chat
went.
for over 30 minutes.
Just left there to do one or two things.
Eh?
I said I just went out to do one or two things, and I don't even know exactly what he even said we should do now. So.
I have left for over more than 30 minutes because I've been having network issues. So I don't really know what
Let's wait. If Mr. Victor will just come up and give us a hint of it, and if not, then we'll wait for the solutions.
But when you left, before you left, so what were they doing, please?
They were doing.
So you could also brush me up on.
Were you there when they started the lecture?
Yes, I was there. I was in the group when they did this the one when he tweaked the question, put in 2019, 20 instead of 2018, 2019, and he told us to calculate the this thing. When it has to do with 1 million shares.
Yes,
at,
yes. So that was
profit after tax 5 million. Huh?
This illustration 2.
Yes. So what was the next one after that, please?
I think the next one was illustration 3.
Okay. What was it all about? Okay,
And
wait first. What was the answer to that illustration 2?
Okay, the answer to that illustration 2 that I changed the date, right?
Yes.
The answer was 5.4 naira per
And what
share.
did they do? Okay. How did they come about it?
Do you have the question with you there?
Yes.
Okay. The question said Arsenal PLC currently has 1 million ordinary shares in issue at this, which is December 2019. So as of December 2019, Arsenal has 1 million shares. They now said in April 1st, 2019,
okay,
he issued 200,000.
Okay.
So I remember they said at the end, the question I've stated in the first place, that at the end of 2019, this man has 1 million shares.
Okay.
Now in April, he has 200 ordinary share issue, which invariably at the beginning of the year, it's not the exact 1 million naira that he has.
Okay.
So at the beginning of the years, he has 800.
800. Okay.
Another 200. That makes it a sum of 1 million naira.
Okay.
So you assume that 800 million naira is for 3 months. Why the 200? Why the 200 share? The 200 that was newly issued. You prorate that one. You prorate that one. That is 9/12 multiplied by 200,000. So that will give you
9/12.
Yes, 9/12. You want to prorate it now because they say he issued it on the 1st of April. So you prorate that one. That will be 9/12. And it will give you 150.
Okay.
So that 150 plus that 800 naira for the 3 months, the total will give you a 950.
Okay.
So remember they said the profit after tax is 5 million naira. So what
Yes.
you do, 5 million naira divided by 950.
Okay.
And that was
Okay. Okay. So after that, what was?
after that one, that was when he was doing that illustration 3, which another method, another technique was introduced. I think there
Okay.
they introduced let me see the question here. They introduced bonus issue.
Okay, bonus issue.
Yeah.
Okay.
That was the one he was solving. In fact, it was even giving explanation regards to that one when I just said I need to go and answer the call of nature. And before I came back now, everything else.
Okay. But can you kindly explain the bonus issue for me? At least the one you had.
Okay. The bonus issue now, they say it's a capitalization of undistributed funds. Right? They said regardless of because if they say bonus issue, they are issuing it from the retained earnings they had before, and they are issuing it to the existing shareholder, not outsiders.
Okay.
So if they are issuing it for them, not that they want to gain additional profits. So because of that, remember the other time when they issue 200,000 ordinary share, it was prorated. But they said when it comes to bonus issue, there's no need to prorate. Regardless of any time the bonus share is being issued, you have to assume it is based on 1 year. So there's no need for prorating in that one. That's just the difference. The other one is he issued it April 1st, 2019. So you prorated it with 9/12 multiplied by. But when it comes to bonus issue, regardless of the month that is being issued, you don't need to prorate. You have to assume it's fully a year.
Okay.
What is this now? But we are more here now.
Yeah?
I say we are more here now. Nobody is even. Hello, Mr. Ola or Madam Ola. I mean, our group now, we are about 6 here.
Yes, so you're right.
Hello, Madam Ola or Mr. Ola.
Or Victor.
Victor is somebody.
Oh, Ifine. Monday.
All this, the 3 of them cannot hear us because they already moved their stuff.
They can hear, but I think they cannot. They should hear.
Okay, that's fine. I think they can hear it, but it's just that they don't want to contribute. But I don't know the question of what this man gives to us, so I don't know.
Hi, has anyone been following the class?
Yeah, I'm following, but I'm having the network issue here.
Oh, okay.
Please, sir, what's the question he gives to us that we should go and even attempt?
I think he said he's having network issues. Gosh.
Yeah, no, what is that? We have to wait for him. So I don't know.
Hello, Mr. Money.
Madam Ireti.
Hello?
Yeah. Madam Ireti.
Yes, please.
Yes, sorry. Thanks for joining. I don't know. We've been here since morning. We don't know the exact question they even tell us to attempt. I don't know. Maybe.
Okay, so he said he dropped it on the chat, but
Okay.
yes, I actually went out. He said he dropped it on the chat, but yes, but I could not even find it on the chat. So I don't know if you can check the chat, you'll find it there.
Let me see if I will be able to get it.
Hi guys, who's on the WhatsApp group?
I am there, but then let me check if I will see the
Mr.
question.
Soji just shared the exam question on the WhatsApp group. You can pick it up from there. The question is question 4, the B part of question 4.
Can you share this question to everyone? Because I'm not on that group too.
Anyway, what was it called now? The WhatsApp group I'm into now, I can't even find the question. I don't have the question with me. So I don't know the platform they are using.
Okay, I'm going to send it to you people now. Let me see if I can attach it.
Okay, thank you so much.
Okay, so I've attached it. It should get to everyone now.
On the chat?
Yes, so you would see a message pop up from, depending on if you're using a phone or laptop. If it's a laptop, you see a message pop up telling you that the message has been sent. So you just check and download the file.
So I'm checking the chat here now. I still can't find it.
Are you using your mobile phone?
Yes.
That's why. I don't think you can see it on your mobile phone.
Okay, I'm also using a mobile phone.
That's the problem.
Okay.
So what you have to do is to go to WhatsApp and get it.
I'm actually not on the WhatsApp group.
But
yeah,
then,
so that's the problem.
Which type of WhatsApp group are they using? Is it on the white stuff? Hello?
Sorry, guys. I have to do something now, so I won't be responding.
Can you kindly read the question for us?
I think you want to try from his own end, so that if any question is being asked, maybe you'll be able to. Because if it's trying to be reading it now for us to capture with it, to take a long time. So if you can check from the OCN, when they are doing the correction, we grab it from there.
Please, how long is this Zoom meeting going to last?
Okay, guys. Let us first of all start from. Can we all hear me?
Yes, sir.
Okay. Let us start from even trying to understand what constitutes participatory preference shares. Have you ever heard of it before now?
Yes, sir.
What is a participatory preference share?
From my understanding, participative preference share simply means that there will be part of the preference share that will be fixed and part of it that will not be fixed. And the part that will not be fixed probably might enjoy benefits that ordinary shareholders enjoy.
Okay, who else will tell us a little about it?
Participating preference share, in my opinion, is a preference share that enjoys the right and privilege of an ordinary shareholder. For example, if there is a special bonus or package for ordinary share, the preference share is that it has a participating right, has the right to enjoy that. And in the event of liquidation, any liability that is accruable to preference share, the participating so that is accruable to ordinary shareholder, a participating preference share will also partake in that liability.
Okay, thank you very much. Okay, I'll send this link to you for you to have a feel of different types of preference shares. Okay, you can copy the link. I'm going to send it to your chat group so that please copy it now. Not that some of us will say, I didn't see it. Okay, I've sent one of the links. I'll send the second one too, so that you can read more on participatory and other forms of preference shares. Okay, I think you'll have done that at your elementary level of accounting, where you do type of shares and all sorts of things. Also within company law, you'll have done that. Okay, now let's go down here to participatory. You can read further other types. But what is participatory here? A participatory preference share provides an additional profit guarantee to shareholders. And to which kind of shareholders? Preference shareholders, which means a participatory preference shareholder, apart from having a guarantee, which is the minimum dividend you must get, which you call fixed dividend, is also entitled to, in pari passu with ordinary shareholders, share of profits for that period. And however, participatory shares guarantee additional dividend in the event that the issuing company meets certain financial goals. If the company has a particularly lucrative year and meets a predetermined profit target, holders of participatory shares receive dividend payment above the normal fixed rate. In another light, from another perspective, a participatory preference share are those shares which are entitled in addition to preference dividend at a fixed rate to participate in the balance of profit with equity shareholders after they get a fixed rate of dividend on their shares. The participatory preference shares may also have the right to share in the surplus assets of the company upon wind-up. Such a right may be expressly provided in the memo and articles of association of the company. Okay, that is that. Now, given the understanding of this, we'll go back to our question. Without you having understanding of that, you might find it difficult to solve that question. And that's why it is better we have appreciation and knowledge of what's it called, of those terminologies or those instruments before we can attempt the question. Let me open the question at my own side here. Give me a minute. Okay, let me share the screen. Now let me read. And along the line where is deemed necessary, I'll make relevant explanation. Now the first question is not part of our discussion. You guys can answer that at your leisure and compare solutions. But the second one is what is paramount. The issued and fully paid share capital of Almond Nigeria Limited, which has remained unchanged since the date of incorporation until the financial year ended 31st of March 2015, include the following. Within the capital structure, we have two categories of shares. The first category are ordinary shares, and as at that date, we had 2.4 million shares in issue. The second categories are participatory preference shares of ₦1 each at 6% fixed dividend, and the total number of shares outstanding is 600 million. For ordinary share, it's 2.4 billion, not 2.4 million. The company has been operating at a profit for a number of years. As a result of very conservative dividend policy in the previous years, there's a large accumulative profit balance on the statement of financial position. On July 1st, 2015, which is 3 months after the year end, 31st March 2015, the directors decided to issue to all ordinary shareholders 2 bonus shares for every one previously held, which means if you have a share before, you get additional 2. Your number of shares will now be 3. That's what it means. Which means this was done 3 months into the year. The following are the extract of the group statement of profit or loss and other comprehensive income as at the end of this current year, which is 31st December 2016. Profit for the year, 740 in 2016, 540 in 2015. Other comprehensive income, nil in 2016, negative 20 in 2015. Total comprehensive income, 740 in 2016, 520 in 2015. But take note, please. In computing EPS, it is only computed on profit for the year, not on total comprehensive income, which means other comprehensive income is not a measure towards computing EPS. Yes. Is that okay? Take note. Okay, now this income is now attributed to non-controlling interest and the parent as shown below. Okay, the following dividend has been paid and declared at the end of the year. And I think the word should have been referred to. The following dividend has been declared and paid. You can't pay before declaring, but let us leave that. Okay. In 2016, ordinary dividend was 330, preference was 69. In 2015, ordinary was 240, the preference was 60. Now, let us do a simple test. Let us do a simple test. What was the preference share capital? What was the preference share capital? The preference share capital, let me annotate. The preference share capital was 600 million multiplied by what? 1 naira. That means 1 naira times 600 million. Will give you how much?
600 million.
600 million. Now, what is the dividend? The fixed dividend
6%
is what? 6%. Now, if that is the case, 6% of 600 million is how much?
6 million.
Is what?
36.
36 million. Now, we have a problem. What is the problem? The problem is the amount of dividend we are told was declared. Was how much?
60. No,
was 69 and 60.
And 60.
Which means if you check here, if you remove 36 from 69, what is the excess?
30.
No, that's
33.
3. What is the SS here? 24.
Oh, billion.
Is that not? Hello? Are we following?
Yes, that's it.
Now, what does this SS represent? This SS of 33 in 2016 and 24 in 2015 represent what we call the participatory dividend that is in excess of the fixed dividend.
Okay.
Now, the question then is, if that is the case, what is the ratio of that to justify? Okay, look at it. If they are collecting excess of 33, okay, like what ordinary dividend will have collected. See, ordinary dividend has collected what? 330, Abi? What is the ratio of 33 to 330? Is ratio 1 to 10. Is that not?
1 to 10.
Which means for every 10 naira you give preference ordinary shareholder, participatory preference shareholder will also get 1 naira. Outside the 36,000, which is the fixed. Fixed is even when you make loss, you pay it. But when you make profit and you are distributing more, in anything in excess that you have distributed to ordinary shareholder, they also take 1 of every 10. That's what it means. The same thing is this 24 to 240. Let us take note of this ratio, 1 to 10. Okay, now what is the question? Okay, before the question. The participatory preference shareholders are entitled to share profits in the same ratio in which they share dividend after payment of fixed preference dividend. The preference shareholders will share the same benefit as the ordinary shareholder of the company should the company be liquidated. Now, we are told to calculate basic EPS and dividend per share. But what matters to me now is, let us calculate all this. I believe everybody has a question. As I switch to the solution board, we now have privilege of coming back to that question. Okay. I can pass question. Question 4. May 2017 FR skills. Now let's start. (2016, 2015). What is my basic EPS? Is my earnings attributable to ordinary shareholders of the group and the weighted average ordinary shares. Okay. Now let's pick it one by one. In 2016, what is this? Is X. And I will say this is what? Y. Those are my earnings. And what is my weighted average number of shares? I can say this is A, and this is what? B. The next question is, what is my X, what is my Y, and what is my A, and what is my B? Let us go to working session. Workings. Now, let me start with this. Analysis of participatory dividend. In excess of fixed preference dividend. 2016, and 2015. If you go by the question, the total preference dividend given to the participating preference shares are 69 million and 60 million. But let us remove the fixed dividend. Remember, fixed dividend is a percentage. They gave us 6%, have you?
Yes, sir.
Of 600 million. Remember, we got 600 million naira. Be careful. If they are giving us 50 kobo, 50 kobo at 600 million will have been 300,000. You have to be careful about the nominal price. Now, 6% of this is 36. 36. Which means the excess dividend given to you, the excess or additional dividend which you are participating in is what? 33 and what? 24.
24.
Now, recall ordinary dividend to the ordinary shareholders were 330 million and 240 million. Therefore, we can draw a conclusion that the ratio is 33 over 330 in 2016 or 24 over what? 240, which invariably give me ratio 1 to 10. Now, this ratio 1 to 10 has now demonstrated that for every time I'm having profit, participating preference shareholders will have 1, while the ordinary shareholder will have 10, which means in all, if I have 11, I'll give 10 to ordinary shareholders, I'll give 1 to participatory shareholders. And that is what that signifies. Okay, given that, let us now look at how that affects our earnings. Remember, let me show you something from our discussion, from the material we are using for our discussion. That's okay. Let's go back to the beginning of our discussion. We said something here. We said okay, it's from here. Now, listen to me. We said earnings calculation. For calculating basic earnings per share, the amount attributable to ordinary shareholders of the parent entity in respect of profit or loss from continuing operation attributable to the parent and attributable to the parent entity shall be the amount in A and B adjusted for after tax amount of preference dividend. Differences arise in the settlement of preference shares and other similar effect of preference share class as equity. That is where participatory comes into. Which means the profit is after you have deducted everything. NCI, deduct any preference dividend, deduct any other participatory or effect on equity. All items of income and expenses attributable to ordinary shareholders of the parent that are recognized in that period, including tax expense, dividend on preference share classified as liability, are included in determining the profit or loss for the period. Now, furthermore, After-tax amount of preference dividend that is deducted from profit or loss is after-tax amount of one, any preference dividend on non-cumulative preference shares declared in respect of that period, and the preference dividend for cumulative preference share required for that period, whether or not dividend has been declared. The amount of preference dividend for the period does not include the amount of any preference dividend for cumulative preference shares paid or declared during the current period with respect to prior periods. Now, let us now borrow that and continue with our solution. In continuing with our solution, what then do we need to do? Note 2. I need to determine my earnings for the year 2016 and 2015. Go to my account. My profit net of tax is how much? Go back to the account on question 4. What is my profit net of tax? My profit for the year was 740.
740 million.
This is profit
740
for the year. And 20 is what? 540. All figure in thousands. Okay. Now, first, let me less preference dividend. Remember? Preference what? Dividend. How much is left? The fixed preference dividend. Remember, fixed. Let me put the word fixed there. 36. What is left? 704 and 504. Is that okay?
Yes, please.
Okay, which means this is the profit attributable to all equity participants, including non-controlling interest, including what's it called? Participatory shareholders. Now, what then do I do? Based on this, what portion of this is due to participatory? Remember, this is after we have deducted dividend. But have we considered the effects of non-controlling interest? Again, we deduct non-controlling interest. 704 is the group profit before non-controlling what? Interest deduction. Now let's non-controlling interest. Share of profit. What is non-controlling interest share of profit? Can you remember? They've attributed the profit into 60 and 40, have you? Can you remove 60? Have you removed 60?
Yes, sir. 644,000.
644,000. Okay. And here you remove how much?
40.
40. That's how much?
464.
Now, which means that this is the residual profits attributable to ordinary shares and participatory preference share what? Holders. In that light, let us now share this profit between them, because all what we need is the profit attributable to ordinary share what? Holders. Now, attribution. Attribution of residual profits or residual earnings to ordinary shareholders of the parent and participating preference shareholders. Remember, what is the ratio? The ratio is 10 to 1. Is that not? Therefore, I come here to say, if I have in 2016, I have 644. What portion goes to parent is 10 over 11. What portion goes to participatory is 1 over what? 11. Remember ratio, have it? What does it give us?
585.
644.
Parent.
Plus what? 5. 455. Have you?
Yes, sir.
0.55. Have you?
Yes,
then put it in decimal. And this gives me 58.545.55.
Yes, sir.
That is still showing the ratio 10 to 1. Now in 2015, what is it? 464 times 10 over 11. And 464 times 1 over 11. What does that give me?
421.
421. 818.18 and
42. 181.
42.181.82. Okay. Thank you. Now, what we are simply doing is that we are trying to get the final amount that is due to our ordinary shareholder. Remember, my earnings to ordinary shareholders of the parent, in summary, in 2016 and in 2015, I can show you on a tabular form so that you can better understand. Is what is my profit for the year?
740.
740 and 540. Less the following deduction. First, NCI share of profits. What was it the other time? 60 and 40. Is that not?
Yes, sir.
Less fixed preference dividend. How much was it? 36?
36.
36. Less participatory. Participatory dividend. Let me call it participatory dividend. What is participatory dividend then? No, I'll just call it participatory share of profit because share of profit is always higher than dividend because dividend is just a subset of the share of profit. Okay? Participatory share of profit, which is for the preference share what? Holders. How much was it? How much?
58.55.
545.
54.
58, 545.
Okay, let me approximate it like that. 545 or 546.
546.
And the other one is what?
542.
No. Is it 42? Okay, yeah, 42, have you?
Yes, 42,182.
Okay, hold on. $42. $42. What?
182. 182 approximately.
182 approximately. What is left here?
$585. 454.
Okay, which is what we got before. 585, yes. 454. Which is similar to that based on my approximation. And this one,
$421,818.
421,818. Okay, which is the same thing. I just show you on the table form. Remember that it's earnings attributable to ordinary shares, which means every other thing, NCI is not part of ordinary shareholder of the parent, fixed dividend for preference share is not, and every participatory in profit other than to ordinary shareholder is not. And that's how we are at X and Y, which means this is our X, this is our what? Y. Therefore, I can quickly go up and substitute for that. What is my X now? Can you call the figure? X is
585.
5 what?
585.
455. Okay. And this is what? 421,818.
Okay.
Okay, we are now looking for A and B. Is that not?
Yes, sir.
Yeah, let's look for A and B. A and B are the weighted average number of what? Shares. weighted average number of ordinary shares of the parent. Okay, we do the same thing for 2016 and 2015. Now, remember, we put everything in thousands. Now, as at beginning of the year, 2015 of April, is it 15? The year end is 2016, is that not?
Yes, sir.
Yes, 2016 is the year end. The beginning is 2015.
March 2016 is.
Okay. Okay. Therefore, okay, let me just call it April because I'm doing for 2015 and 2016. Therefore, it will be wrong for me to put dates there. Let me just put 1st of April. 1st of April. First April, and I put this 2016, this 2015, 1st of April. Now, remember that the year ends, let me put it on top, 31st of March, 31st of March, so that we are not confused of January to December. This is not January to December. This is April to March year. Okay? What is our opening balances of our share capital? We are told that there have not been additional shares up to end of 2015. Is that correct?
Yes, sir.
What it signifies is that what was outstanding as at 2015 has been existing for incorporation. That's what we're told. Which means 2.4 billion was existing as at 1st of April 2014, which up to the end of the year, there was no new issue of what? Shares. It is this 2.4 that we carry forward to 2016. Is that correct? Okay.
Yes.
Now, in 2016, or let me say, in the year between April 2015 and March 2016, there was bonus issue. Issued when? Issued on 1st of July 2015, which was 3 months. This is what? 3 months into the year.
Yes.
And we are told that the bonus is 2 for what? 1 existing. Therefore, how many bonus will be issued now? If you have already 2.4 existing and you have to issue 2 for 1, how many are existing?
4.8.
4.8.
4.8. Which means if you have 1 share before, they are giving you 2 additional. 2 plus 1 is what? 3. That is what it means. Okay. Take note. And this is now 6 points. Is it 6 or 7?
7.2.
7.2. Now, the question is this. Why are we not going to weigh this? Why are we not going to weigh it? Because it is bonus. No, because it is bonus. Bonus is deemed to have been in existence from the what? Beginning of the year. Are you getting it? Can you recall? If not, we will have prorated it. We will have prorated this additional 4.8 by 9 months because July to March next year is 9 months. Therefore, this is the weighted average ordinary shares of the parents. Are you getting it now? Okay, we'll now take that as A and B. This is A, and this is what? B. I take it up. What is my A now? 7.2. And what is my B?
2.4.
My B is what? 2.4
2.4.
shares. Now, what is my basic EPS? This is
0.08.
This is 18 kobo. And the other one is
0.6.
0.08.
This is 8 kobo.
Yes.
Okay. But take note, this is just basic EPS in each of the year. But for comparative purposes, each of the year independently, which means in 2015, this is what we'll have gotten. But because we are now in 2016, and we remember that whenever there's a bonus issue, we go back for comparative sake to adjust for the effect of bonus. Remember, there was no bonus in 2015. That's why our number of shares is showing 2.4. It's not showing as if 2015 performance is far better than 2016. 2015 gave me 18 kobo. 2016 gave me 8 kobo. It's like I've done poorly. But is that correct? Not necessarily. Remember, there was bonus in 2016 and it never contributed additional resources. It's the same existing resources from 2015 that still existed in 2016. Therefore, we need to go back and carry out adjusted EPS for 2015. Therefore, I'll come here for the sake of comparison. Basic EPS of 2015 have to be adjusted for the effect of bonus shares issued in 2016. Hence, my adjusted EPS in 2015 will be basic EPS times adjustment factor. Remember, what is our adjustment factor? Our adjustment factor, my basic EPS is 0.018. My adjusted factor is existing shares before bonus over total shares after what? Bonus. Now, what is that? 0.18 multiplied by 2.4 before bonus. And what is it after bonus? 7.2. What is my adjusted EPS? My adjusted EPS is
0.06.
0.18 multiplied by 2.4 divided by 7.2. That's what? 0.03 per what? Per share. Can you see that we can now easily compare the two? That in 2016, our basic EPS is 0.08, which is 8 kobo. While the adjusted EPS, considering the effect of bonus, if it was issued in 2015, it will have been 6 kobo. That is what we can compare with another, not the 18 kobo. Comparing 18 kobo will be abnormal because you are comparing apple with orange instead of apple with apple.
Yeah.
Does that make sense?
Yes, sir.
Yeah. Any question? Any question? Any question? That is basic EPS, Abi. Therefore, you guys can go and compute dividend per share. That one is very straightforward. It's just dividend per each person divided by share capital. That's very straightforward. Okay. Now, if you go to ICANN solution, I'll point areas of corrections in ICANN solution for you. Okay. Now, let me open the solution. First, they never considered that the position of standard is that basic earnings per share is only computed for ordinary shares. Ordinary shares is of no relevance in basic EPS because it is the ordinary shares that is listed in the capital market. Okay, and ordinary shares are those that have the final residual stake in the business. Now, let me show you something here. Let me annotate it so that I can pick all where those differences lies. Okay, first, if you come here, I think everything we did as the same, no problem. But let's go to the additional information, the workings, sorry. Okay, let me start with working 2. Now look at this working 2. They used 740, which was right, and they deducted this. Remember, we got this 704. Mm-hmm. They used 520 here, which was wrong. Why? We are not to use total comprehensive income. We are to use what? Profits for the year. EPS is not computed on total comprehensive income. It's computed on profit for the year. Did you pick that one?
Yes.
Okay. Okay, that's 1. 2. Because of that, there will be error at that point in time. But let us now look at the second one. The second one is this. Here, okay, before then, okay, this 704 was used without considering the fact that out of the 704, okay, sorry, it's not showing what I need to show. Out of the 704, there is amount for non-controlling what? Interest. Remember, 60, which ought to be deducted. That's how we got 644. Now remember, non-controlling interest is not part of the ordinary shareholders of the parent. Can you remember from group accounts? Yes. And also, this was not 440, this was 460. If you remember, you know, if remember what we did here, we said this is not 520. This is supposed to be 540. 540, this will give you 504. Yes. Okay? Now, that 504 is what they're supposed to use here, but they are using 484. Similar to our problem of 704. Here also, it is not 484, like we cancel 704 here. It is 504 minus NCI. NCI is what? 40. That's how we got 464. Can you remember?
Yes.
That also is a problem. Now, that affected the portion you are giving to participatory shareholders, because it is this 644 and 464 that will now apply ratio 1 to 10 on. And that's where the mistake came from. And what they also did that mistake is that they were looking at number of shares of both ordinary share and participatory. But participatory have to be removed in determining the basic what? EPS, which means they're supposed to have stopped at 7.2 and this. But because they have included participatory profits also in the earnings, they are also now including participatory preference shares. But participatory preference share or its earnings should not form the basis of determining basic EPS. And that's what I'm saying. Okay, that is the position of the standard. Okay, that is where that little error came from. Okay, now for dividend per share, it's very straightforward. It's just for you to calculate dividend per share for ordinary shareholders and dividend per share for participatory preference shareholders. And the solution is in tandem here. And you can see it here. Dividend per share for ordinary shareholders is, remember this, our share of profits. Sorry, the dividend paid to the ordinary shareholders and ordinary share, and that's okay. Why preference shares, participatory, preference shareholders, remember it is 69. 69 given to them is made up of 36 and additional 33. And this is made up of 36 and additional 24. Remember, we did one analysis. Okay, why the number of share capital remains the same. And that brings us to the end of basic what? EPS. Any question? Any question? Any question?
Sir, I would like to ask, what about the issue of diluted EPS and that? I think I have seen a question like that before.
Okay, that means you are not paying attention to us. When we started the class, we said we have two types, basic and diluted. And that we are going to discuss basic today. And also in my remarks just now, I said this is the end of basic EPS. Now, we use today to go and digest what we have done. And we now, because you can't do diluted without basic. Basic accounts for 90% of diluted or more. Therefore, it's just for us to now make adjustment to this basic to determine diluted. That's why today you have to go back, revise, do all what you need to do, so that tomorrow we'll still make reference to today and we'll move on to diluted. Is that okay?
Yes, sir.
Yeah. The other aspect I'll have also considered, which are not going to make any difference, very straightforward, is what if there's share construction? But I think that should be for professional level. But again, you can read it up. Where there's a share construction, there are two forms of share construction. You can either reduce your nominal price or increase your nominal price. If your nominal price before is 1 naira and you reduce it to 50 kobo, what you are doing is that you are increasing number of shares, but the capital remains the same. If your nominal price was 1 naira before, you increase it to 2 naira, it means you are reducing number of shares, by increasing nominal price, and the capital still remain what? The same. That is what we call share reconstruction. We can bring about share consolidation or share split, but that is not necessarily within your syllabus. But again, it's very simple analysis, very straightforward. It's not even up to these complexities we have done. Very straightforward, and you can also read it up. Any other question? Please check your chart. I'm uploading this solution to your chart.
So,
please.
Okay, sir. Can you also upload the one for where you treated the rights issue?
It's one single sheet.
Okay. Okay.
Everything.
Okay. Share construction on EPs.
I've shared it. Network disconnected. You sent. Network disconnected. What does that mean? Okay, let me convert it to PDF.
Not received. Okay.
Today is what, 29th August?
Yes, sir. Yes, sir.
2020. Okay, let me share it in PDF. Okay, the PDF is going.
So we can't get the record version.
Record version, what do you mean by record version? Hello, what do you mean by record version?
So that include voice and everything.
Hey, you always get that one now. That one will be after Zoom, I've released it to my cloud. And it will take minimum of 2 to, because there are many people doing this live show in different parts of the world. It takes average of 1 to 24 hours. But because I have higher assets, it should be within 2 hours, I should get it. And once I get it, I send it to various platforms. My, what's it called, platform?
Wise.
Wise platform or my own personal platform, Finponomics. You see it there. Okay, have you seen the solution now? I've uploaded it. Have you seen it?
Yes. How am I going to join your own platform?
My platform is already filled up because the maximum is 257 on, except you join the one on Telegram. Probably I'll post the link of Telegram later.
Okay, I appreciate that.
Okay, but you can also see some of those videos on my YouTube channel.
What's your YouTube channel?
Just look for Olumiwa Adebayo. Okay, please download the solution, and that brings us to the end of the class today. Thank you very much for your effective participation.
Thank you very much, sir. Thank you very much.
Thank you for your time, sir.
Yeah.
Thank you, sir.
Yeah. Bye.
Thank you, sir.
Bye-bye, sir.
Bye.